Bonjour et bienvenue à ce quatrième épisode de la série sur la transition CDOR, produite par le groupe de travail sur le taux de référence complémentaire pour le marché canadien, que l'on surnomme le TARCOM, en collaboration avec le groupe TMX. Je suis Élodie Fleury, directrice générale gestion des changements réglementaires à la Banque nationale marchés financiers, et je co-préside le sous-groupe rayonnement et communication du TARCOM. Avec cette série d'émissions, nous espérons atteindre deux objectifs. Engager l'ensemble des participants de marché dans la réalisation de la réforme du taux de référence au Canada et collaborer étroitement avec les autres sous-groupes du TARCOM pour articuler un message consensuel clair afin d'aider les participants de marché à réaliser une transition ordonnée et éclairée du taux CDOR vers notre taux sans risque, le CORRA. La première vidéo de cette série visait à vous donner un portrait global de la transition, son historique et son calendrier de jalons importants à haut niveau. La deuxième portait plus spécifiquement sur la transition des dérivés de taux, la troisième sur la transition des titres au comptant. Aujourd'hui, nous allons vous parler du taux CORRA à terme, qui, comme son nom l'indique, est un taux prospectif. Ce taux n'existe pas encore, mais devrait voir le jour en septembre 2023. Un panel d'experts de l'industrie a été réuni aujourd'hui pour vous livrer les tenants et aboutissants de cette thématique, avec pour modératrice Jacqueline Green de la CIBC Marchés de capitaux, qui co-préside le sous-groupe sur le CORRA à terme du TARCOM. Le sous-groupe du CORRA à terme est composé de représentants des secteurs publics et privés, bancaires, institutionnels et corporatifs. Et son mandat consiste à évaluer l'intérêt du marché pour un taux prospectif et à élaborer la méthodologie de calcul d'un tel taux et ses cas d'utilisation. Je vais maintenant céder la parole à Jacqueline et ses invités pour qu'ils nous présentent leurs réflexions sur le sujet.
Hello, everyone. I'm Jacqueline Green, Head of Financial Markets at CIBC Capital Markets and a co-lead of the term CORRA subgroup that has been created as a part of CAR. Today, I'm joined by a number of industry professionals who have been integral to the creation of a term CORRA rate that will be used in the transition from CDOR to CORRA in the Canadian financial markets. We have Nicholas Chan. Nick is the Head of Financial Resource Management at BMO Capital Markets, and Nick also co-leads the term CORRA subgroup created by CAR along with myself. Marc Laberge, Head Trader and Portfolio Manager for Rates and FX Derivatives at Desjardins. Allan Levitt, Managing Director on the Global Markets team at CIBC Capital Markets. And last but not least, John Lunt, Senior Quantitative Analyst at CIBC Capital Markets. Marc and Allan have been leading our use cases workstream, and John was the lead on the methodology workstream that developed the recommended methodology for term CORRA. I'll kick off today by noting that the creation of a term CORRA rate has and continues to be a huge industry-wide effort with contributions from many different parties across Canada and globally. And so without further ado, I'd like to start things off by spending some time talking about why there is a need for a term CORRA rate within Canada. Allan, can you share your perspective with us on this topic?
Okay, I'm going to start with the most obvious, which is that the transition to CORRA represents a very significant change for all parties that have relied upon CDOR in the past. Recognizing this, a survey was done very early by the use case committee with respect to the contemplation of a creation of a term CORRA index of corporate and commercial counterparties to understand what their needs were. The responses that we got back pointed very substantially towards the strong desire for the creation of a term CORRA for both maintaining operational simplicity and as well allowing forecastability of cash flows. We've also clearly looked at the experience elsewhere, and specifically I point to the US, where transition from LIBOR to SOFR was actually moving very, very slowly until the advent of a term SOFR, at which point there was an acceleration of that transition. We believe, therefore, that this is the right thing to be able to offer our clients, and thus the degree of effort that's been put into this endeavor.
Allan, just on your point with respect to some of the experience, obviously Canada's part of the global framework and global initiatives towards moving to international risk-free rates. Any learnings you would highlight or take away from the experiences that we observed as a committee in other jurisdictions that you think was important to apply to the Canadian context?
I mean, I believe so. And again, I continue to sort of point to the experience in the US. I recognize that there's a broader market, but this is the market that the vast majority of Canadian clients that certainly CIBC and other banks in Canada face. If there's a secondary market that they are focused on, it's going to be the US first and then others, secondarily. Realistically, the desire for sort of something simplicity is paramount here. Many clients did indicate that, if in the absence of a term index, could they deal with an overnight index? They could, but it certainly wouldn't be a preference. It would be a distant second for the reason of predictability of cash flows, essentially. Many clients, we have everything from extraordinarily large corporate clients to mid-market clients and below that are reliant currently on CDOR. One of the benefits of it is simply understanding the numbers, understanding interest payments, swap settlement payments, things along those lines well in advance of when they're due. This allows their own operational practices to be maintained with some integrity.
One thing that I would perhaps highlight as well that was very relevant as a part of this consultation is that it was clear that the corporate and commercial community required a term rate for the lending product. And we're going to talk a little bit about the use cases later, but just a lot of the references that you're making, Allan, as we talk about them are really with respect to lending, which is where we're seeing the term SOFR rate used in the US as well.
Exactly right. And for the clients that have hedging requirements related to these lending facilities, the ability for a term CORRA index in Canada to apply there as well is certainly important. The symmetry is necessary for these clients.
Exactly. Nick, do we want to maybe turn things to the methodology side? And we were joined by John, as I mentioned earlier, who is very integral to the creation of the methodology.
Absolutely, John. Maybe just give us a bit of a taste of the journey that you had kind of gone through with respect to developing, the new term CORRA index for the Canadian marketplace.
Yes, thanks, Nick. So when the committee asked us to sort of form a subgroup to produce a methodology for this, one of the key requirements was that the term CORRA rate could be published by an independent administrator, and we'd normally expect the administrator wouldn't have to apply any sort of expert judgment in publication of the rate. In practice, that means that the term CORRA is a data-driven algorithm, and it's initially only depends on the sort of CORRA futures data. The CAR website has a document which explains in extreme detail what the term CORRA methodology is, but I think I can give the sort of highlights and the main points of how the algorithm operates. So we had the advantage of being able to see the work that had been done in other jurisdictions, and in particular, there's the term SOFR, which uses the work of Hypefield and Park and is used by the New York Fed for their term SOFR rate. And we were inspired by that, but then obviously made some adaptations for the specific to the Canadian market. So the basic idea is we build a yield curve for the overnight CORRA rates, and those rates are allowed to move the day after a Bank of Canada fixed announcement date. And then we calibrate that curve to the market data. Initially, that's the 1 month and 3 months CORRA futures prices from the exchange, and from that we can then imply forward-looking 1 month and 3 months term CORRA rates. So, I mean, given that description, the key fact is then what futures prices are going to take, and as you know, liquidity in that market has been developing over time. Maybe you can speak in a minute to the sort of guarantees that are being given by various institutions, but the document specifies the minimum amount of the data that we need. We take futures prices from both the 1 month and 3 month contracts. We prioritize real transactions, but there's also provision that executable bid and offer prices can be taken into account when deriving the futures prices. And then finally, there is also a fallback provision. So in the event of sort of temporary reductions in liquidity below the thresholds, the document also defines a sort of a fallback mechanism, so the rate can be continued to be published in those circumstances. So that I would say that's the sort of high level overview of the algorithm. Yeah, maybe you'd like to comment on the sort of assurances of liquidity that the institutions have given as well, in order to sort of get us into the initial ramp up phase.
Absolutely, John. Thank you. I think before I get into that, I think I just kind of want to punctuate. There was a market response to the need for a term CORRA index, specifically in the lending community, and the response was taken with a lot of seriousness and a lot of thoughtfulness. The methodology and the work that John's group has done is it really takes into account a lot of different things. Not only looking at international standards, but also just ensuring that the index is going to live through time and be a robust index through time through different prevailing market conditions. I would say thematically on the practitioner side, I think this was a good outcome. The Canadian front end is used to trading cleared futures, migrating from what had historically been a BAX contract that was set off CDOR into an arrangement for 3 month term CORRA contracts that is done through a market making agreement and a soon to be announced 1 month agreement. Over time, like the hope is that we will get the sufficient amount of liquidity, not only through the commitments that John referred to that the dealers are making with respect to maintaining bid offers and certain volumes in the pit, but also real transaction volume, which is really the ideal state. We're against the backdrop now of a lot of market uncertainty, notwithstanding significant changes to monetary policy expectations related to market stresses, but just prevailing credit conditions. So I think I think John's point is correct. It's taken some time for the liquidity to develop, but we're really looking at the June 30th date of this year, where we expect to see and the upcoming 1 month arrangement as well that's going to be disclosed and announced by the TMX. We hope to see that liquidity pick up, but the dealers are committed, the industry is committed, and we're looking for this to be a robust index through time. I think with that, maybe this is a good segue, and Jacqueline, this is probably a good segue back to sort of what the use cases are for term CORRA and how we thought about that development. So maybe I'll pass it to you and Allan to comment.
Yeah, thank you, Nick. And I think you've touched on some of the points already that this group, again led by Allan and Marc, in our use cases work stream focused on, which is robustness of the rate, avoiding the inverted pyramid, which we've seen in other regimes, and also some of the learnings that have been taken out of the US as an example with their term rate. So Allan, maybe I'll start with you. We'll go back to what we talked about earlier, which is what are some of the allowable use rates that we have landed on? And Marc, I'll turn to you afterwards to talk a little bit about where we're at from a derivatives perspective as well.
Certainly. So the approved use cases for term CORRA that have been published thus far are loan products, are trade finance products such as discounting of receivables, and single currency derivatives for end users hedging a term CORRA loan where the end user is either the lender, the borrower, or the guarantor under such loans. A decision as to whether to add interdealer single currency derivatives will be made later on, closer to the establishment of a term CORRA index. And to your point, Jacqueline, like this is among kind of the learnings from the U.S. There is an issue that is well understood in the U.S. with respect to term SOFR effectively being a very one-sided market that has caused a basis which is not inconsequential to develop between the overnight compounded and the term index, and the goal is to avoid that type of eventuality in Canada. Additionally, and I very specifically said single currency derivatives. Cross-currency derivatives, such as basis swaps, may eventually be permitted, provided that that is something that becomes generally utilized in other jurisdictions as well.
Okay, and maybe I'll probe on that a little bit further, and I'll open it up to both you and to Mark. But as we thought about the use cases as a community, why was it that we stayed away from institutional products like FRNs? And this is a question that we get from from the corporate side on occasion, and so I think it's important to address.
I'll start with that. I mean, you've also mentioned sort of the inverted pyramid. The concept here is that the compounded overnight rate is really the market standard, and it is where we need the vast majority of traded volume to be in order for a term index to actually have any meaning and be representative of the market. And so to that end, limiting the use cases to what is absolutely needed versus what would be nice to have becomes quite important.
Okay, thank you. Mark, maybe I'll, Allan spoke a little bit about this, but maybe I'll turn it over to you on the derivative side, which I know has, there's been a lot of focus spent on that, just generally, but also with respect to the interdealer point. Is there anything that you want to add there?
Yeah, absolutely. Thank you, Jacqueline. Thank you, Allan. So basically on the derivative side, in the term CORRA consultations, we, of course, had seen clients be very clear that they need the term rate. You also saw financial companies, i.e. banks and lenders such as us at Desjardins, saying, well, the bank that provides derivatives to clients to hedge their term CORRA loans will like to be able to hedge this in a transparent market. However, this needs to be put in comparison to the inverted pyramid problem, where you don't want to have too much volume based on that term RFR product. So there is a delicate arbitrage to be made on between these two, an equilibrium, I should say. So, but there is documented challenges in the U.S. on the term SOFR, with the inter-dealer market being restricted, and you could find some documentation on that on the web, saying there is issues on illiquidity, bringing extra capital charges, some transparency questions, and the fact that the market is one way, like Allan was saying, all loan hedgers are basically paying this basis. So we were looking in Canada to make sure we provide a robust benchmark that functions well in the term CORRA derivatives market for clients as well, with all the right equilibrium on each of these factors. So there was an industry-wide effort to provide that within our work stream and our work with other work streams, working groups, such as the loan work group and the ATR, accounting, tax and regulation work group as well. Just to remind everyone that the CORRA first initiative is actually in play right now, which is basically the conversion of the market towards a daily compounded in arrears market. And I'd say we think like the 95% of the market will trade under daily compounded in arrears. The term rate is there to accommodate clients who want it, who need it. But the main liquidity will be in the daily compounded in arrears market. That's very important to know. Hence, this will create a forecasted additional hedging costs for clients using the term CORRA derivatives market, in the sense that it's less liquid, it's more costly for the institution to warehouse this risk because they can't hedge it perfectly, and they have potentially extra capital costs, which is still in the works on that side. So the borrower who wishes to borrow in term CORRA for simplicity, cash flow certainty, operational simplicity, has a choice to see if he wants to have this extra simplicity and certainty versus an extra cost. So there is this question for every client to ponder to see what's optimal for them. So I would say that's mostly the situation for the derivatives market. On the CORRA first initiative on daily CORRA, I just wanted to mention it is going very well. There is a specific webcast that you can look at on this point. And the latest stats we've seen is that 42% of single currency derivatives cleared on LCH were now on CORRA. Versus the rest on CDOR, versus 58% on CDOR. So this is going very well, and this is in advance of the CDOR date of where there's no more derivatives on CDOR, except if you hedging a CDOR specific instrument, which is June 2023. So we're very much on plan, even a little further along than we had thought at this point. So this is very positive.
Mark, that's very helpful. Thank you. Is there, given that you're also, you kind of sit on multiple angles of this transition, just in your title and role, any perspective here on some of the things that we talked about earlier with respect to, the central limit order board, whether we'll get real transactions going through from an index setting perspective? How do you see that liquidity developing over the next little while?
So this is a very good point, Nick. So to what John was speaking on the methodology, the core futures market, which is basically the short end of the market, it is a transparent and public market. So it's the greatest transparency you can get. So this is why the index is based on futures and was constructed this way. The 3-month contract was already being supported through a market making program. 2 market makers are involved in this program, and it was forecasted to replace the BAX market and have similar liquidity, even if maybe better, because as it moved to RFR, it would be more in line with other jurisdictions now. So this is going well. The BAX futures is slowly reducing its liquidity, and the CORRA gaining. So we see this flip happening, I'd say closer to the June 2023 deadline. Just keep in mind that if you're trading already a future past the June 2024, a BAX past June 2024, it's already a CORRA futures theoretically. It will flip to CORRA plus a spread, synthetic CDOR, if you might say. So you're already trading a CORRA futures, even if you don't realize it. So this transition is going well. The CORRA 1-month futures was a bigger challenge in the sense that even in the US, the shorter futures have been less liquid than the 3-month months. And part of the fact is when a future falls between bank dates, and everybody knows the future daily rate until that next bank, it doesn't trade anymore. People don't need to hedge anymore. If you add forward guidance by a central bank where there's a pause, then there's a few futures contracts that don't trade anymore. If you want to build a robust index, you want to have observable prices. So the idea was to prevent a lack of liquidity on putting in danger the robustness, the statistical robustness of the term core index. So this is where an additional market maker program was put on for specific specifically for the 1 month futures. And this, as you said, will be announced very soon with two dealers having taken that role. And this is essential. And my understanding, it's a 3-year period. So we have a 3-year period where this will be supported, and until the market picks up enough liquidity to see what happens after that, to ensure it stays robust in the future.
Yeah, thank you, Mark. I think the general trend and theme, and you've probably observed this, Mark, as a practitioner as well, is futures volume in Canada are generally down. I think that's just been a theme that we've experienced probably over the last 2 to 3 years. There's probably less two-way participants, speculative risk in the market. So, but it's good to see that the existing liquidity is, from your perspective, and I think mine as well, that the existing liquidity is going to transition. Yep. And I guess hopefully once we get through some of this prevailing market turmoil, we'll start to see more, just generally more volumes go up in terms of more participation in Canada as a total complex.
Yeah, and to your point, we need to take into account the futures market is just a portion of the liquidity that's out there. So the OTC market is very liquid. It's functioning well. It's how we are able to transport part of that liquidity in the futures market, where it's 100% transparent for the need of the calculation of the index. That there's many ways to address that. So we are working that as an industry-wide effort to make sure that the futures market is liquid enough.
So before we finish up here, we've talked a lot today about the creation of term CORRA, what is going to contribute to its success. And I think it's important to just spend a couple minutes talking about what we would view as the off-ramp in the, what we hope is an unlikely event where it does not remain a viable rate after the cessation of the central of the club. And so with that, maybe I'll open it up to all of you to talk a little bit about the dialogue we've been having around the importance of fallbacks and of having what I'm going to call a plan B or an off-ramp to the, in the event that term CORRA is ultimately not successful.
Okay, so to that point, Jacqueline, I think it's very, very important that the clients who use term CORRA in their loan agreements or in derivatives have robust fallback language referencing the overnight CORRA compounded in areas. Of course, we are working very hard to make sure the term CORRA is robust and lives on, but there is a risk of it not surviving, even if it's very small. So having that fallback in there to prevent any legal valuation vacuum in there. As we know, the daily CORRA index is very, very robust. We have no worries on that end. So it is very important to have this language in there. And this is totally different from the language of the fallback from CDOR to CORRA, which I will talk to just in a few minutes. But just to finish the point on the fallback to the daily CORRA, just know that there is also some work on our loans working group to create market conventions on an ability to switch what we call an off-ramp from term to daily. So if any client who has a term CORRA product, a derivative or a loan or a derivative matching a loan, chooses to switch to daily for extra liquidity, reduced hedging costs, will have the ability to do it without amending their whole documentation, which is pretty burdensome. So there is this work being worked on, a mechanism specifically worked on by our industry experts to help us achieve that as an industry, so we don't do it bilaterally with every client in different ways. So there will be a standard. Speaking of the fallback from CDOR to CORRA, very, very important point that was mentioned in the CORRA First webcast as well. Note that the recommended languages that are on the CORRA website were taught on and designed per product, not as a product hedging another. So the loan fallback was thought up for the 80 to 85% of people who have loans but have no swaps or hedge against it. Hence, the focus on the term CORRA for operational simplicity and cash flow certainty. The derivatives part was driven by ISDA consultations in 2019, way before the term CORRA was even thought of, and this will fall back. The derivatives part will fall back on the daily compounded in arrears. So, and this is the recommended language for the ISDA languages, and this is how the derivatives are falling back. So in June 2024. So if you have both products and expect magically for them to match, you need to address this and make sure if you need it as a cash flow forecasting tool to match those through an amendment. So this is an important point to talk to your representatives or your legal department to make sure that if you feel the fallback, the recommended fallbacks take care of all cash flow matching in the future, please be very cognizant that you need extra effort on that part.
Yeah, to that point, there will be a significant need for bilateral conversations between clients and financial institutions to ensure, again, symmetry, the absence of which creates basis risk, which I mean are acceptable to some clients and not to others. And the goal is to make sure that, ultimately, when the transition, by the time the transition is complete, that everyone is fully comfortable with, packages, as it were, of loans and derivatives where such packages exist right now.
Very important advice. Thank you both.
I would maybe just add, I mean, the market will seek liquidity where liquidity is available. And as we said, we're all hopeful that this is failure, the potential failure of this as a benchmark is a tail risk event. But just given the thoughtfulness around fallback and we know that there's deep liquidity and overnight, I think the market should be well prepared. John, was there anything else that you think you would want to add from a methodology perspective on this point?
Nothing major. I mean, I would point out that the document that's been published does allow the administrator to take account of other liquid instruments. So, for example, in other jurisdictions, some of the interbank trades are reported centrally. Any change to the published methodology would involve a public consultation and taking of comments, but there is explicit. The methodology itself is somewhat flexible, and as you say, other pools of liquidity may well develop, in which case the methodology could take those instruments into account, subject to a public consultation run by the independent administrator.
Yeah, if I may add also, like in the big picture, the term CORRA is there and will be there for clients who need it and who value the operational simplicity and cash flow certainty. But like we say, bear in mind that the deep liquidity is in the daily market at 95% of volume. All the institutional players will be there. So it is available to you once you get the systems and the operational capacity to do it. So we ask clients to consider this and review it and make sure they have the off-ramp we're talking about to go there when needed without amending all their documentation.
Absolutely, that's all valid points. Thanks, Mark. I'm going to take just a few moments here to wrap up. On behalf of the group that's on the panel today, as well as all the members that have contributed to the term CORRA working group through CAR, we want to thank you for taking the time to view the panel. I hope you picked up some key themes. One is the development of term CORRA came through industry consultation, and it was a response to a real need. And two, there's a lot of thoughtfulness and development work through the methodology stream and also just in constructing the use cases to ensure that this is something that would match the needs of not only the clients that we're responding to and the use cases we're responding to, but as well as any changes to regulatory regimes that we would need to be cognizant of in the future. And third is just to be sensitive that this is a developing thing. CDOR has been in the market, for many decades. The international trend towards RFRs, risk-free rates, is big, and that's not losing any momentum. But there might be some things that we have to consider along the way which just picking up on the points in the last question around the off-ramp and ensuring that we have the right fallback in case things don't go as we planned. The market is in a good place and set up to pivot as needs change. So if you have any further questions, there's going to be materials on the website. You have access to this panel, and please feel free to contact any of your representatives for further clarification points.
Merci d'avoir visionné cette vidéo. Nous espérons que vous avez apprécié entendre les perspectives de nos experts concernant l'avènement du taux CORRA à terme. Quelques points clés sur lesquels nous tenons à insister en conclusion de cette discussion. Premièrement, les jalons importants par rapport au développement de ce nouveau taux de référence. Au deuxième trimestre 2022, le TARCOM avait lancé une consultation pour savoir si les participants de marché voulaient un taux à terme CORRA. Les résultats ont confirmé que oui. Donc, le groupe de travail, et plus particulièrement le sous-comité du CORRA à terme, a travaillé à l'élaboration de la méthodologie de calcul de ce taux. Le 11 janvier 2023, le TARCOM a annoncé, via un avis au marché, l'élaboration d'un taux CORRA à terme pour les échéances de 1 mois et de 3 mois. La méthode de calcul reposera sur les contrats à terme CORRA de 1 et de 3 mois transigés sur la Bourse de Montréal, à la manière du taux SOFR à terme de la CME. L'utilisation du taux CORRA à terme sera restreinte aux prêts et aux produits dérivés liés à des prêts. Des précisions restent à venir sur ce sujet. Il est attendu qu'il sera plus cher d'utiliser des dérivés indexés sur le taux CORRA à terme que des dérivés indexés sur le taux CORRA composé à terme, en fonction de la liquidité. Une version bêta du taux CORRA à terme devrait être produite au deuxième trimestre de 2023 avec un lancement officiel prévu en fin de troisième trimestre 2023. Enfin, il est fortement recommandé d'insérer des clauses de repli robustes dans les produits fondés sur le taux CORRA à terme. Ces échéanciers et points saillants sont tirés de la présentation webinaire du TARCOM présentée lors du premier épisode de cette série, laquelle peut être consultée sur la page web du TARCOM sur le site de la Banque du Canada. Merci encore pour votre attention et restez à l'affût des prochains épisodes de cette série. Le prochain portera sur la transition des prêts aux entreprises, un sujet en continuité avec celui du taux CORRA à terme. Ne ratez pas ça.